So, the stock market the last couple of weeks has been up and down, wouldn't you say? More down than up if we're being real. Now, the question becomes, how do you not panic? Sell all your positions, stocks, index funds, etc. at the very bottom to keep your investments on track. And how do you stick with it until the craziness subdues, until we get back to steady, predictable increases? We'll talk about that coming up on BTP Fusion. What's up, you guys? You're watching BTP Fusion. I'm your host, Derek West, and it's our mission to inspire you to take action to improve your finances and business through the power of technology. You can help us in that mission by smashing that like button if this video brings you any value. And if it does not, you can drop us a comment letting us know how we can improve and get the content that you need to be your best financial self. Anyway, so for the last decade or so, markets seemingly went up and up and up. And when the market is up, everyone and their brother is telling you that you just need to get into the market. If you don't get in now, then you're going to miss a chance to get in on the action and make your money work for you instead of the other way around. But I don't want to get in the market. But you should. But what if it goes down? It won't. Are you sure? Positive. That'd be the typical conversation between your average Joe and the stock market bro. You know, the guy that really loves the stock market and everything about it. You know, that said, during this whole run-up, there were people who were warning the public that a big crash is coming and will eventually wipe out the gains that were so hard fought during this time. And like a broken watch, they were right at least once. You see, markets go up, and when they do, it is best to have been on the ride since the beginning. But markets also go down, and when they do, it's best to have gotten off the ride right at the top of the roller coaster. If you can get into the market when it is cheapest and get out of it when it's at its peak, and then buy back in when it's at its next cheapest, you could easily get very wealthy. And therein lies the rub. No one knows when that's going to happen. No matter what you hear on CNBC or your favorite investment YouTuber, nobody knows when a market is about to go pop. And nobody knows when we've hit the bottom of a market. This current swing that we're going through could go on for months and months, having us lose up to maybe 10%, 15%, 25% or more on all of our investments. Or it could reverse itself and go back to steady, slow, yet predictable gains. Or some are saying it could skyrocket from here. The point is, nobody knows. In all honesty, the market is sort of unpredictable, and even the best of the best traders act on hunches, while the rest of us are just reacting to events and what we see or hear in the news, and also the financial data from companies and economies and things like that. So, investing when markets go up and up is not a hard task to complete. All you have to do is buy in and watch your money grow. Now, anyone with a working index finger can do that and be very successful at it. But investing when the markets are tanking is probably one of the more difficult things to do in the world. Investing in general can be, and is, a really simple concept. Buy low, sell high. The mental and psychological strength that you need to pull off sticking with it during the bad times can be quite tough to acquire. However, that is to say, not everybody is born with the ability to watch as their hard-earned money goes down the drain, seemingly into oblivion. As your investments lose 10%, 15%, 25%, maybe more in value. Does it really take a steely-eyed pro, Wall Street shark type to maintain composure, keep calm, and keep investing on? Nope. Like I said, anybody can do it. It just takes a little bit of mental training and toughness to get to that point. I really break it down into 3 easy concepts. Play with house money. Don't invest money that you'll need in the short term. The order of operations when acquiring and building wealth is 1. Get a skill, either through college, real-world experience, or a site like Udemy or Skillshare. But truth of the matter is, cleaning toilets is never going to pay enough to really, truly invest with money that you're not going to need immediately. 2. Become the best at what you do. Once you acquire a skill and get a position or start a company that focuses in on that skill, then become the best at what you do so that you can demand the right price for your services. When I say that, what I'm really talking about is maximizing your first income flow. When you do this, it then becomes easier to save an emergency fund. Now, you might want to do this before step 2 or during step 2, but you want to take a portion of your salary and stock it away into an emergency fund regardless. In the event that the economy goes sour, or you lose your job, or your company goes under, or all 3, then you won't be in as desperate a position. All of those things happen to real people, and they can happen to you too. So it's best to be prepared. And if you are prepared, you don't have to scramble if and when the worst does occur. Simply dip into the emergency fund to hold you over while you figure out your next move. Don't get caught up in what is the right number to save either. Just try and hit half your income saved to start off. And then try and build up to a year's salary. If you get close to either, you'll be doing better than 90% of your neighbors. The important thing is to try and save a significant chunk for such an occasion. But once you do that, now you're in a position for number 4, set money aside for investments. And this is what I mean by playing with house money. Let's assume for a second that during a bear market, you manage to keep your job or your business and maintain your income level through it, and you have your emergency fund stashed away. If your investments lose 10%, 15%, 20%, and you know that you have an emergency fund stashed away and a job or a company that is focused on skills that people want or need, then you'll all of a sudden have a different mindset. It's no longer, do I need to liquidate my investments or will I have no money? It's more of a, oh well, that investment went sour. Where else can I put my money for a good gain? Or even better, let me wait this out and see how bad it gets. Or the best, I'm just gonna do nothing. I did my homework on these investments and they're solid. So I'm gonna ride it out and wait for the market to go back up. Now you have control and a solid foundation for future success. You're not panicking because you invested the money you need to pay your mortgage or your rent. But let's imagine a more dire scenario. You've now lost your job or your company and the economy is in a protracted recession that may last 6 months or more before hiring picks up. You can simply stop investing at the clip you've been investing at and live off your emergency fund for a period of time while you get back on your feet. If it gets really bad, you can get a job that you're overqualified for while you wait for jobs that you are qualified for to open up. In both cases, you should be fine, and your investments will be fine if you don't panic. But if you're the panicky type, simply don't look at your investments. If you follow the previous advice, you should be good to go. Unfortunately, people still do panic when markets go south. In doing so, they get out of their investments at the bottom, and then when the market turns up, for the better. They are typically traumatized. They no longer trust the markets, and they don't get back in. Now, don't be that guy or gal. Here's the thing that works for me. If you don't know how bad it is, you can avoid the psychological trauma of watching your investment nest egg shrink, and thus avoid the urge to quote-unquote do something. Now, it helps to purchase instruments that tend to auto-correct themselves if you're going to go with this sort of thing. With that in mind, index funds would be the way to go typically. Just keep in mind though, not all index funds auto-correct. Low to no fee index funds are simply baskets of stocks. Higher fee index funds and other mutual funds with fund managers are the type of investment products that are managed to try and beat the performance of the market, both on the way up and the way down. A lot of people are really into low to no fee funds nowadays, which isn't a bad thing, but it means that more or less what you see is what you get. And generally speaking, your fund will probably perform at the same level as the rest of the market. But in the long run, you will save on fees, that's for sure. But now, if you're the type of person who panic sells, you're probably better off not getting into ETFs, individual stocks, and other investment tools, as they require more work, research, that sort of thing, to really be great investments. With that though, they tend to have larger negative and positive swings. Even with all of that, you still have to, even with all of that, you've got to trust the process. If you look at the history of the stock market, it has tended to go up. For example, the S&P 500, which was founded in 1926, has averaged 10 to 11% annual return. Now that's an average. Some years were gangbusters, like in 2019, and other years were just terrible, like 2008, like 2009, like 2010. But it does average out at least 8% for the long term. That means that if you stick to a long-term game plan and you invest consistently, you can become very wealthy or at least have quite a bit of money to do whatever you want after a certain period of time. And if you do your research, you find stocks that are worth holding and you assemble your own diversified basket of stocks, then you'll do just fine. Or even if you buy an index fund that holds all the best stocks and you hold that index fund, also, you'll be just fine. It's a process, and that means following through and not panicking when the chips are down, but in reality, going all in. And if you stick with it, you too will be just fine. Speaking of sticking with it, if you want to stick with us, Be sure to subscribe and punch that notification bell for more great videos from BTP Fusion. Also, if you liked this video, then like the video. Duh. If you didn't, leave us a comment telling us why. Hey man, we ain't perfect. We're just out here trying to stay calm in this now erratic investment environment just like you. But while you're at it, leave us a comment on how you plan to implement these 3 steps. Are you invested in index funds, ETFs, or individual stocks? No matter what's the case, how are you doing? Are you thinking of moving out of your positions, or are you planning on sticking with it? Comment down below to get the conversation going. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take action on your finance and business, and we'll catch you next time. Peace.